Welcome to the eye-opening world where paying less in taxes isn't just a dream, it's a reality for those in the know. Imagine keeping more of your hard-earned money, legally, and watching it grow. Surprising, right? But true. Here's a shocking fact. The wealthiest Americans sometimes pay a lower tax rate than the middle class. How? They know the secrets of the tax system. And now, you can too. In this series, we'll unravel the mysteries of tax codes, uncovering strategies that could lower your tax bill to the ground. From the simple steps like maximizing deductions to the more advanced tactics involving retirement savings and investment strategies, we're covering it all. Did you know there are ways to earn income without paying a penny in taxes on it? Or that choosing the right business structure could save you thousands, if not millions, over the years? These aren't loopholes. They're just lesser-known parts of the tax laws that can work in your favor. We're diving deep into these strategies, with real-life examples, easy-to-understand explanations, and actionable advice. Whether you're a budding entrepreneur, a hard-working professional, or somewhere in between, there's something here for you. So, buckle up. You're about to embark on a journey to financial freedom, where paying less in taxes is just the beginning. Let's get started and unlock the secrets to keeping more of your money where it belongs, with you. Chapter 1. Introduction to Tax Law and Your Rights. Welcome to the world where paying less in taxes is not just a dream but a legal reality. Today, we're diving into the smart strategies that can significantly lower your tax bill, and it's all above board. So, let's get started. First off, understanding your tax rights is crucial. It's like playing a game. If you don't know the rules, how can you play to win? The tax code might seem complex, but within it lies a treasure trove of opportunities to save. Did you know that the average American pays about 14% of their income in federal taxes? Yet, there are legal ways to reduce this significantly, sometimes even to zero. It's all about how you manage your finances. One of the simplest strategies is maximizing your deductions. For instance, if you work from home, parts of your home expenses become deductible. That's right, a portion of your rent, utilities, and even internet can lower your taxable income. Charitable donations are another gold mine for tax deductions. Not only do you help those in need, but you also reduce your own tax liability. It's a win-win situation. Investing in your future through retirement accounts like 401ks and IRAs can also lead to significant tax savings. The money you contribute often goes in tax-free, reducing your taxable income right off the bat. But here's a kicker: if you're self-employed or run a small business, the way you structure it can have huge tax implications. Choosing between an LLC, S-Corp, or C-Corp affects how much tax you pay and how. Ever heard of the Augusta Rule? It allows homeowners to rent out their homes for up to 14 days a year tax-free. Yes, tax-free income, just like that. Investment strategies can also play a big role. Long-term investments are taxed less than short-term ones. So, thinking long-term not only builds wealth but saves on taxes. Tax loss harvesting is another tactic. It sounds complicated, but it's essentially selling off investments at a loss to offset capital gains. This can lower your taxable income and save you money. Did you know that some of the wealthiest Americans legally pay little to no taxes? They use these strategies and more to keep their money where it belongs in their pockets. Now, you might think, but I'm not a millionaire. That's okay. These strategies can work for many people, not just the ultra-wealthy. It's about being smart with your money. Chapter 2. Maximize your deductions and credits. Moving on to Chapter 2, we're going to dive deeper into the world of deductions and credits, the secret weapons in your tax-saving arsenal. These aren't just line items on your tax return, they're opportunities to significantly reduce your tax liability. So, let's break down how you can make the most of them. First up, deductions. Think of deductions like discounts on your tax bill. The more deductions you have, the lower your taxable income. And lower taxable income means less tax owed. It's like finding money you didn't know you had. One of the most overlooked deductions? Health savings accounts, HSAs. If you have a high deductible health plan, you can contribute to an HSA pre-tax. This not only lowers your taxable income but also gives you a pool of tax-free money for medical expenses. It's a double win. Then there's the student loan interest deduction. With student loans being a common burden, this deduction allows you to deduct up to $2,500 of the interest paid on your student loans each year. It's a small relief that can make a big difference. Moving on to credits, These are even better than deductions. Why? Because they reduce your tax bill dollar for dollar. It's like the government giving you money back for making smart financial moves. The Earned Income Tax Credit, EITC, is a prime example. It's designed for low to moderate income workers, and the amount you can receive depends on your income and family size. For some, this credit can be a game changer, putting thousands of dollars back into their pockets. Child-related credits are another area where you can see significant savings. The Child Tax Credit, for instance, offers up to $2,000 per qualifying child. And with the Child and Dependent Care Credit, you can claim up to $3,000 for one qualifying individual or $6,000 for two or more. That's a substantial amount of money that can offset the costs of childcare. But here's a strategy that flies under the radar: the Savers Credit. It rewards low and moderate income individuals for contributing to retirement accounts. Depending on your income, you could get a credit of up to 50% of your contributions. Not many people know about this, but it's a powerful tool for saving on taxes while saving for retirement. Chapter 3: Retirement Savings and Tax Benefits. Chapter 3 takes us into the realm of retirement savings and their significant tax advantages. It's not just about stashing money away for the future, it's about smartly using these savings plans to reduce your current tax bill and grow your wealth over time. Let's explore how maximizing your retirement contributions can lead to substantial tax savings. First, let's talk about the traditional 401k plan, a favorite tool for many. Did you know that contributions to your 401k are made with pre-tax dollars? This means every dollar you contribute reduces your taxable income for the year. For 2023, the maximum contribution limit is $20,500 for those under 50, and an additional catch-up contribution of $6,500 for those 50 and older. Imagine lowering your taxable income by that much. Now, not everyone has access to a 401k, but there's an alternative: the traditional IRA. While the contribution limit is lower, at $6,000 with a $1,000 catch-up for those 50+, the principle remains the same. Contributions can be tax-deductible, directly lowering your taxable income. It's like giving yourself a pay raise by saving for your future. Roth IRAs and Roth 401ks offer a different kind of tax advantage. While contributions to these accounts aren't tax-deductible up front, the magic happens later. Your money grows tax-free, and you can make tax-free withdrawals in retirement. This can be a game-changer, especially if you expect to be in a higher tax bracket later on. Let's not forget about the September IRA, designed for self-employed individuals and small business owners. It allows for much larger contributions than a traditional IRA, up to 25% of your income or $61,000 in 2023, whichever is less. This can massively reduce your taxable income while bolstering your retirement savings. Another key strategy involves timing your contributions. By making contributions at the start of the year, you give your investments more time to grow, maximizing compound interest. This isn't just a tax strategy, it's a wealth-building strategy. But retirement accounts offer more than just tax benefits. They're a critical component of your financial freedom journey. By understanding and utilizing these accounts to their fullest, you're not just saving on taxes, you're securing your financial future. Chapter 4: Utilize tax-efficient investment strategies. Chapter 4 shifts our focus towards tax-efficient investment strategies. It's not just about how much you invest, but how smartly you navigate the tax implications of your investments. By choosing tax-efficient investments and employing strategic tactics, you can significantly reduce your tax bill and enhance your returns over time. Let's explore how. One of the simplest yet most effective strategies is holding investments for the long term. Investments held for over a year are taxed at the long-term capital gains rate, which is significantly lower than the short-term capital gains rate applied to investments sold within a year. For most investors, this difference can mean paying almost half the tax rate on their gains. Index funds and ETFs, exchange-traded funds, are stars in the world of tax efficiency. These investments typically have lower turnover rates, meaning fewer taxable events. Plus, their structure often results in lower capital gains distributions compared to actively managed funds. This can be a boon for investors looking to minimize tax liability. Tax loss harvesting is a strategy that sounds more complicated than it is. It involves selling investments that are at a loss and using those losses to offset gains from other investments. This can lower your taxable income and your tax bill. It's like making lemonade out of lemons, turning investment losses into tax-saving opportunities. For those in higher tax brackets, municipal bonds are a gem. The interest earned from these bonds is often exempt from federal taxes and, in some cases, state and local taxes as well. This makes them an attractive option for tax-free income, especially when compared to taxable bonds with similar yields. Another consideration is asset location. It's not just about what you invest in, but where you hold those investments. For example, placing high-growth investments in Roth IRAs, where withdrawals are tax-free, can be a smart move. Conversely, holding investments that generate taxable income in tax-deferred accounts can defer taxes until withdrawal, potentially at a lower tax rate in retirement. Diversifying your income through investments can also play a crucial role in tax efficiency. For instance, dividends from qualifying stocks are taxed at a lower rate than regular income. By incorporating these into your portfolio, you can enjoy lower tax rates on your investment income. Did you know that strategic charitable giving can also benefit your tax situation? Donating appreciated securities directly to a charity allows you to avoid paying capital gains taxes on those investments, all while supporting a cause you believe in. Real estate investments offer another avenue for tax savings, through depreciation and other deductible expenses. Plus, the 1031 exchange allows investors to defer capital gains taxes when selling a property and reinvesting the proceeds in a new property. Chapter 5. Legal entities and structures for business owners. Chapter 5 delves into the intricate world of legal entities and business structures, shining a light on how the right choice can lead to substantial tax savings for entrepreneurs and business owners. Understanding these options isn't just about compliance, it's about strategic financial optimization. Let's explore the tax benefits of different business entities and how they can contribute to your wealth-building journey. Sole proprietorship is often the first step for many entrepreneurs. It's simple to set up and requires less paperwork. However, its simplicity comes with a drawback. The business income is taxed at your personal tax rate, and you're subject to self-employment taxes. But, with proper expense tracking and deductions, sole proprietors can significantly reduce their taxable income. The limited liability company, LLC, is a popular choice for its flexibility. LLCs offer the benefit of pass-through taxation, meaning the business income passes through to the owner's personal tax returns, avoiding the double taxation faced by C corporations. Plus, LLCs allow for the deduction of health insurance premiums, a non-negligible benefit. S corporations take the pass-through benefit a step further. Owners can be treated as employees and receive salaries, over which payroll taxes are paid. However, any additional profits can be distributed as dividends, which are not subject to self-employment taxes. This structure can lead to significant tax savings, especially for businesses that generate a substantial profit beyond a reasonable salary for their owners. C corporations are subject to corporate tax rates, which are different from individual tax rates. This entity allows for income splitting between the corporation and its owners, potentially lowering the overall tax rate. Additionally, C Corp offer benefits like deducting the cost of benefits, health insurance, retirement plan contributions, and retaining earnings within the company for future growth. However, it's crucial to navigate the potential for double taxation, once at the corporate level and again on dividends received by shareholders. An interesting strategy within the realm of C corporations involves the use of fiscal years. Unlike other entities that typically follow the calendar year, a C corporation can choose a different fiscal year end, potentially deferring taxes or taking advantage of lower tax rates in specific periods. For those with international aspirations, the choice of entity can also impact taxation on foreign income, with certain structures providing more favorable treatment under U.S. tax law and treaties. This requires careful planning and understanding of both U.S. and foreign tax systems. It's not just about the taxes, though. The right business structure can protect your personal assets from business liabilities, provide opportunities for raising capital, and influence your business's credibility and perception among customers and investors.